Hello and welcome to Switzer Super TV. Paul, how are you?
Great, Peter.
Tell us, earnings season, you've had a close look at, sum it up for us.
Well, actually, it came out pretty well, and I think maybe because expectations had been hosed down a little beforehand. But if you look at how this season went to other earnings seasons, on most metrics, it's come out pretty well indeed. So compared to sort of the normal earnings season, 53% of companies exceeded expectations. The norm there was 43%.
That's good.
In terms of lifting profits, 66%, or the same as normal, lifted their profits on the prior corresponding period.
Yep.
64% of companies reported an increase in dividend compared to the norm being 62%.
That's superb.
And probably the one I really like, Peter, is in terms of how the market reacted to the individual results. 56% of companies saw their share price outperform the market on the day they announced their results.
Yeah, that is good. Putting it all together, it seems to me that was a great reporting season. What does it mean for the next reporting season? Do the analysts react to that and then change their view on the next 6 months?
Well, they do. Whenever we get more information, either for a company report or other information, the analysts re-crunch their numbers.
Yep.
And as a result of that, they've actually lifted their expectation around average earnings per share. Coming into the reporting season, the analysts were expecting earnings per share across all companies to grow by 13%. So that's compared to the previous 12 months.
Yep.
They've now increased that to 14%. And doesn't sound a lot, but that actually means quite a bit when you translate it back into share price, if you can get a 14% increase, with the standouts being resource companies and the banks.
And also it makes me feel as though the 6,000 level that you and I picked earlier in the year for the ASX 200 index looks more a possibility.
Well, I think that was one of the major litmus tests that we'd said if that reporting season wasn't good, then we'd probably have to rethink hard about that forecast. Personally, I took a lot of confidence out of that because overall, I mean, we saw both, not just profit growth, but there was some underlying sales and revenue growth as well. Plus, we got some good outcomes for shareholders through higher dividends. Okay,
one final thing. The outlook for resources from earnings season was good. China's got some bad data earlier this week and the market was down. Is this a temporary thing, do you think?
I always worry about China data.
Yeah, so do I.
A, because it comes out the weekend.
And also there's all those holiday data in there as well, isn't there?
And B, we had the impact of the new year and no one quite knows what that means. Yeah. Look, I think what we're seeing with the resource companies, we're certainly seeing the major producers like BHP and Rio very focused on increasing productivity from their current mines, very focused on how they spend capital, so they're taking a much more disciplined approach to capital expenditure, and promising both higher dividends and things like potentially off-market buybacks for shareholders later this year. The downside is commodity prices still seem to be under pressure, and we've got the iron ore price under $120. So, look, I think you've got to have a position in the major miners, but maybe we're not going to see that sort of stellar year we might have been hoping for 3 or 4 weeks ago.
Personally, I think it will end up being a buying opportunity because I think the global economy is improving. It will help commodity prices later in the year. And that's my guess at this point in time. Thanks for joining us for Switzer Super TV.